I'm very delighted to welcome Odeta Kushi, Deputy Chief Economist from First American, to our podcast. Odeta Kushi is real celebrity in my mind. She's a prominent voice in real estate. She provides analysis, commentary, forecasts, trends on all the aspects of U.S. real estate and mortgage markets. I know a lot of my listeners are or do care about mortgage dynamics and forecasts. She's a go to expert for journalists, industry professionals, policymakers, and executive leadership. I actually met Odetta at the conference in Washington, D.C. We had a wonderful discussion, and I said, I have to have you on my podcast because I think you're a celebrity. I read your X all the time. Phenomenal analytics. Whoever doesn't know Odetta should really subscribe to her feed on X. Odetta, welcome to the podcast.
Thank you so much, Alex, for that very generous introduction. It's truly a pleasure and an honor to be here with you today. I'm excited for our conversation.
Sounds good. There's so many things I want to touch, right? So let's just start with overall economy and go down to the real estate and mortgage market. On one of the investor calls that I had yesterday, somebody asked me to comment on the forecast of my businesses, and I told them I can't do it. I can't do it. First of all, I don't have a data. Second of all, it's very hard with all the changes that's going on with the government, Trump 2.0, everything around us. It's very dynamic, and it changes in a matter of a day or an hour. So let's start with sort of your view of what we see on the economical front and how you look at the economy today.
Yeah, absolutely. I mean, I think you're spot on. The word of the day is uncertainty. It's really hard to plan a business with things changing so rapidly. I mean, I can speak for myself that I am changing these slides like the hour before a presentation because the world has changed in a matter of hours. Um, so I think what I like to do in these instances is take a step back from the day-to-day fluctuations and just try to look at some of the core fundamentals in the economy. I'm happy to share some slides if that's helpful.
Absolutely.
I
We love
cover
slides.
data always. So I have a couple of macroeconomic slides that I think might be useful context here. So I will share my screen and talk about the dual mandate of the Federal Reserve because that's what I think all eyes are on at this point.
Absolutely.
Just switch here. Okay, there we go. And I'll share my screen.
Perfect.
Okay, so I'm calling this the new macroeconomic environment because it's been a long time since we've seen uh, some of the dynamics we're seeing in today's market, particularly as it relates to tariffs. So, taking a step back, how are we doing relative to the Fed's dual mandate? On the unemployment front, we look really strong. The unemployment rate's 4.2%. That's exactly where the Fed has projected it to be over the long run. So that's a healthy unemployment rate. The inflation rate's been making significant progress towards the Fed's 2% target. That's good news. It's been maybe a little bit stickier than everyone had hoped, but progress is welcome, and we have a 2 on that left-hand side of the decimal, which is good and certainly good compared to where we were in 2022. And I think some of the nuance that's missed when we're talking about the inflation data is we have to break it up because it has so many different components. And I like to look at it in three parts. The first, of course, is goods inflation. That's where everyone is paying attention these days because the tariffs are really impacting the goods sector. Now, the goods sector really skyrocketed in 2021, 2022. I don't know what you were doing, but I was buying like bread machines and I bought a Peloton and like all the things that I was purchasing because we couldn't leave our house. So that really contributed to a lot of demand side pressure. And then, of course, supply chains were all blocked up. So you had this double whammy of demand and supply side blockages, which contributed to double digit inflation in goods. Now, once the world started to open back up again, I suddenly stopped caring about making bread and started caring about attending and going to bakeries. And so that put a lot of stress on services because we all started to travel and go to restaurants again. And So we saw a lot of pressure in the services side. Now, where we're at today is that goods inflation is right around the long term average. So, not a lot of red flags in the goods sector. Services inflation, which is really dependent on wages, is still above historical averages, but making good progress towards normal. And then the other component that I like to break out of services is shelter, because shelter is worth about 40% of our core inflation measure. And that shelter can confuse people because it's actually not measuring the purchase side of the market. It's just looking at rents. And so it's really measuring rents, but with a significant lag, over a year lag in measuring rents. So what we're seeing in new leases, that's not going to appear in the shelter component for another year, year and a half. And the reason I mention that is because I think that there's disinflation baked into the shelter component of inflation, which again is 40% of our core CPI. So there's reason to believe that the overall inflation will continue to make progress towards the Fed's target. And that's good news. And even on the services side, like I said, services is 86% of our total employment is in the services sector, really wage dependent. So when we see the quits rate in the economy tick below pre-pandemic levels, that means people aren't really leaving their jobs, right? They're feeling a little bit uneasy about the macro environment. They don't think they can get a better offer elsewhere. And so they're staying put. That likely means we'll see that reflected in wage growth. So we do expect continued downward pressure on the services inflation side and on the shelter component. So really the big question mark is around goods. And I do expect to see upward pressure in the goods sector as, we start to really pull forward demand for goods, trying to get ahead of these tariffs. So I think that we have some headwinds from the goods portion of inflation and some tailwinds with services and overall shelter inflation.
Odeta, if I read your charts correctly and I focus only on unemployments versus the quits rates, it tells me that the folks are not hiring. There's very hard to find a job, but unemployment is still low. I wonder if there's a lag effect to reflect all the announcements that happened in the beginning of the year with respect to layoffs by our governments or, yeah, I guess firing of our Doge governments, or folks that are laying off with the mortgage market, right? Consolidation, layoffs. So all of that does not show here. Does that mean that we have this lag effect? Because people are not quitting; they're afraid to lose their jobs, but the unemployment is still steady and actually was surprisingly better than expected.
Yes.
Is there a lag effect anywhere that is not accounted on the charts here?
I think you're absolutely spot on. And if I move over to this chart, this is where we start to see some of the underlying cautionary flags about the labor market. Yeah, on the face of it, it all looks good. But to your point, we've had government layoffs. Arguably, that sector still makes up a relatively small share of the overall labor force, but nevertheless, it is impactful. But when we start to look at the reasons for unemployment, that's where it gets a little bit hairier. So here you're looking at all the drivers of unemployment since January 2023. I mean, keep in mind in 23, the unemployment rate was even lower at 3.5%. So we're up to 4.2. And the reason for that rise in unemployment has predominantly been permanent job losers. And that's really the most recession relevant component of unemployment, because that means that people are losing their jobs and unable to find other work. Believe it or not, you can have good reasons for rising unemployment. And by that, I mean you could have more people re entering the labor force, and that's causing the unemployment rate to rise. But that could mean that people are just feeling confident about their prospects of finding a job. So that's a little bit concerning. And then to your earlier point, the hires rate is at about 2013, 2014 levels, which is when the unemployment rate was 7%. So if you have a job, you're okay right now. We're not seeing a ton of layoffs. But if you're out there looking for a job, particularly if you're a student that just graduated, it is really tough. You are having a really hard time finding a position. And I think unless we start to see the job openings and the job hires rate, we can expect that unemployment rate to rise, especially in the face of tariffs, right? Tariffs pose upside risk to inflation, as I mentioned on the good side, and pose downside risk to unemployment because who's hiring when they don't know? To your point, you can't forecast your business. How are you supposed to forecast how many workers you'll need?
Yeah, that's certainly a difficulty on my part, but let me just add to your points and let me know if you agree with my thesis here. Um, Many of the college grads were obsessed with the YouTube videos on how to make $1 million, and a lot of the numbers or a lot of the grads after college started to be started a small business shipping on Amazon. And the shipping was very simple. It's a drop shipping from China through Amazon to their location, rebranding, and then shipping forward. uh, that business with tariffs does not exist. So I wonder how big that workforce is that shows as self-employed, but in essence, they will all be, call it, closed or laid off just because of China uncertainty and tariffs, where whole business was Alibaba to purchase, Amazon to sell. And that doesn't exist anymore. That doesn't work anymore.
Yeah, I mean, it's the numbers are tougher to make work in that environment. We did get some positive news with the 90-day reduction in tariffs between China and the US, which actually cut down the risk of the macroeconomic risks. It's been estimated by about 40%, and that includes unemployment and inflation. So just that negotiation with China did brighten the outlook a little bit, but we're still at the highest effective tariff rate since 1934. And that's really impactful, to your point, to small businesses who maybe can't absorb that shock. Maybe bigger businesses are able to cut into their margins a little bit and they can't pass it on to consumers. But small businesses might have a harder time. And consumers are telling us time and time again they can no longer take any more price increases. They are tapped out, right? It's been multiple years of inflation and they can't really handle any more price hikes. And so you'll see that pullback in demand from the consumer side as well. And consumers king in this country. 70% of our economic growth is based in consumer spending. So if we're feeling a little shaky to spend at restaurants and shopping, that will reflect in our GDP data.
Yeah, I agree with that. And I think to make the problem worse, as you mentioned, that the college kids are struggling to find a job. And especially after this disaster with the China tariffs, they'll probably start looking to find jobs in the different fields. And I think based on our conversation earlier, there's a big gap in the skill labor, right? They don't have the right education. They haven't been in the industry. And I am worried that we will see the effect of skill labor mismatch. I think I saw one of your slides in Washington that you were talking about just that, right?
Yeah. No, there is the skills mismatch is a very real issue. If the demand for labor out there isn't quite matching the supply of labor, then you'll see that start to reflect in the labor market data as well. So it certainly is a concern for sure.
Yeah. And then the second point that I wanted to make on your slide with the permanent job losses, um, do you have a sense on the relationship of multiple jobs held by one person and the fact on your chart? Or that's sort of baked in?
That's a great question, and the BLS does actually track multiple job holders. I haven't looked at that data recently, but to your point, that matters, right? The if people are having to take on more work or having to work more hours in order to stay afloat, then that's stress in the labor market that needs to be captured and measured.
Yeah, so I think both of us are worried, right? So on the surface, we started with everything looks great, unemployment numbers are low, right? The inflation is in check. Um, the people don't quit, great. You did say the word recession. I didn't want to say it yet, but Let's touch on that. Do you think we're going to the recession? I mean, I went to the conference yesterday in New York. It was hosted by Houlihan Lockheed, and they said, nope, nobody sees a recession. Not anymore. Everything's great. We're open for business. But you mentioned it, so let's let's
Let's talk about
ask
it.
for your opinion. Yeah, let's bring it out.
Let's bring it out. That the big question mark on, that word. It's really tough to forecast a recession, and honestly, it's very hard to define a recession. There's not a lot of good measures. I think the rule of thumb, sort of the heuristic, has been 2 consecutive declines in GDP growth. But even that's not perfect because, GDP is just one measure. There's a broad swath of measures that you could look at to really get a better sense of what a recession is. And it's the NBR Business Cycle Dating Committee, BCDC, that typically makes these decisions. And they look at everything from, wage growth, the labor market, manufacturing, to determine if the economy was in recession. And they even look at things like depth and duration. So the recession in 2020 was very deep, but very short, right? By their standards, it was 2 months, March and April of 2020, but the economy contracted substantially because everything shut down. So that's all to cover myself as I tell you how difficult it is to forecast a recession. I don't think a recession is imminent. I think that there are still forces at play that can have us avoiding a recession, but I certainly think that the probability of a recession has gone up. I mean, if you were to ask me in December versus today, my recession odds would have increased significantly. And I think part of that is, I don't know if I have a slide in here. Yeah. So the consumer, as I mentioned, they're feeling stressed. They've had, several years of price growth. And when we look at credit card debt, we can see that real and nominal credit card debt has increased. And the delinquency rate on that credit card debt has increased from about 7.5% in 2022 to nearly 12% in the latest available data. So consumers are spending, but they're financing that spending with credit card debt that they're having an increasingly difficult time repaying. And we see a similar trend with auto loans. And then, of course, now we have student loan debt repayment. And all of that is stress on the US consumer. And if the US consumer stops spending, that is when we start to see trouble in the GDP data.
What is the one thing that you look for that will tell you, "Oh, we're in trouble now." My odds of recession went up, doubled. Is the credit card data the right matrix to look at, or the unemployment again? It looks great, but I just don't see it on the market. So something doesn't tell me the full story. Is there one matrix or indicator that you're monitoring to give you warning signs?
So, going back to the labor market data, I think if you want something high frequency that's starting to sort of wave the flag that we're in trouble, I would probably look at claims. So, filing unemployment claims because we do get that data weekly, and if we start to see a positive trend, you know that there's some stress in the labor market. So, I'd probably look there, but it really is sort of looking at the totality of the data. I mean, even the GDP, well, my little circles are off here, but you get the point, right?
Yeah.
The GDP data for Q1 came in negative, but that was due to some sort of accounting anomalies. Typically, GDP is a little economist wonky here. C plus I plus G, consumption, investment, government spending, and then imports minus exports. So the news headlines were saying if you import a lot of goods, then that'll put downward pressure on GDP. But that's not necessarily the story because typically then that import will show up in consumption or inventories. So what I like to do to sort of remove the noise of GDP is I look at the real final sales to private domestic purchasers. And we show here that once that dips below 2% is typically when we've been seen entering a recession. And as you can see sort of here from the last couple of data points, we're not quite in recessionary territory according to this estimate. We're sort of just flatlining at this point. And so that's again another reason why I believe it's not necessarily imminent that we'll fall into recession. And even if we do, it's a question of depth and duration. What will it really look like? I think we all bear scars from the global financial crisis, but it's not to say that this will look like that necessarily, right?
Yeah, that makes sense. So in my mind, if I would be forecasting to make sure a recession doesn't happen, correct me if I'm wrong. Two things must happen. One is we need to be friends with China again and get tariffs to close to zero, and Feds will need to cut the rate for significant amount, not just half a percent or 0.75%, just to make sure that they go down the road of what they've been talking about all along, but substantial rate cut to reopen the mortgage market and lending market. What are you, am I right, or there are more things that you think can happen to avoid the recession?
I think that the Fed cutting rates is certainly one aspect of it. I think yes, reducing the tariff tensions will certainly be helpful. I don't know that we're going to get to zero. We might sort of ease on down to sort of a baseline 10% looking tariff rate, but certainly that would help. I think what we need is certainty, a little bit more certainty. And that goes for the macroeconomic picture, that goes for the Federal Reserve's decision, and that goes for real estate as well. I mean, spreads between the 10-year treasury and 30-year fixed rate mortgage, those spreads are really dependent on the outlook and whether we have some level of certainty on the outlook for the macroeconomy. So I think we just need to sort of find our footing and have a little bit more certainty in the outlook. Right now, it's just, everyone's sort of frozen. They're not sure what to plan for.
Yeah, I echo that, and I think everybody were frozen definitely in the Q1 of this year. I feel that things are opening up in Q2, at least on the investment M&A front. A lot of deals are being done, and I do sense that there's a lot of dry powder on the at least investment world market. Um, is that related to sort of a hope that what we're talking about here will actually happen?
Yeah, I think a little bit of it is, people thinking that the Fed is going to cut rates. I mean, they've telegraphed to us, I think I have that somewhere, but that they're going to cut rates by about two times, 225 basis point rate cuts. And then the market is sort of shifting depending on what the incoming data report is of the day. Both the Fed and the market are not great at forecasting what the Fed's
Yeah.
going to do. But, when we get a hot inflation print, they sort of pull back expectations on rate cuts. When we get a hot, if we ever get any bad labor market data, they'll say, "Oh, the Fed's definitely going to cut more." I do think that the Fed is going to cut rates in the second half of the year, really just to sort of prevent any heightened risk of job loss recession. Like I said, on the inflation front, there's some disinflationary forces baked into that data. So I think they might prioritize the labor side of their mandate in the second half of the year.
Okay, so we're switching from inflation to labor market from the view of the Fed. That's interesting. Well, that's probably um, the tailwind. What about headwinds? If you said that there's what 40% chance, is that what JP Morgan and Chase said? There's a 40% chance of recession. I think they revised that. No.
They might have revised that. Yeah, there's so much incoming shift in recession expectation.
So let's look at 40%. 40% recession would mean for us, if we would forecast towards the end of the year, is Feds are staying put. There's a tension and uncertainty on the market continues. China is playing a hardball, and they're playing chicken with U.S., and that's not a good game to play, at least on the world stage. Anything else that you think can cause a deep recession if that event would happen?
I mean, in the event that, we don't make headway on the tariff negotiations and the Fed, uh, and we're sort of in this recessionary environment, um, I just always come back to the labor market and US spending. That's what I'm watching day in and day out.
Yeah, yeah. And from my perspective, I mean, I'm all about tech. Certainly, cyber wars. That's something that I saw recently in the past week. I noticed that a few large companies were affected. That really makes me so worried that it's so easy to to cause a large spike in some sort of a in the market just by cyber wars. Um,
Absolutely.
yeah, but let's dive into our market, right? So it's mortgage and real estate. So we
Absolutely.
talked about overall market, and obviously Feds will play a big part in mortgage rates and lending. What do you see on the actual mortgage market and broadly real estates?
I'm glad we're getting to my area of expertise here.
There you go.
Yeah, so I think on the housing front, residential housing front, the existing home side of the market has been a little bit frozen. We haven't seen a ton of movement. Sales are really struggling to make any sort of progress. And we did see a little bit of a decrease in mortgage rates in the first quarter, a steady decline that now has come back up as the 10-year treasury has started to drift higher. And as I'm sure your viewers are well aware, the 30-year fixed rate mortgage is not dependent directly on Fed action, but more dependent on what's happening with that 10-year treasury. And that 10-year treasury can be impacted by everything, right? Geopolitical tensions, wars, inflation, macroeconomic uncertainty, all of the above. And so it's very difficult to forecast, and it also is very important. And then the spread between that 30-year fixed rate mortgage and the 10-year treasury is also important because historically it's been about 170 to 200 basis points. And in the peak, it reached 315 basis points. And today it's a little bit closer to 260. So we're not quite back to normal, but we're not quite at the peak of the spread. And that means, mortgage rates are still elevated near around 7%. Now, the industry consensus is that we're going to get lower rates by the end of the year. We'll get to about 6.4% and then just a touch lower next year. I certainly would agree with that, especially if we have a monetary easing scenario in the second half of the year. We could get a little bit of a decline in mortgage rates, but I do not expect mortgage rates to get below 6% unless we truly have a recession that the Fed will need to act accordingly. So I think mortgage rates in the 6 to 7% is sort of our new normal at this point. And that's okay. That is what mortgage rates have been historically, actually a touch below historical mortgage rates. The bigger issue is that when we talk about affordability, it's not just mortgage rates, incomes, and house prices. And house prices, according to our data, continue to reach new heights, at least nationally. And, with elevated mortgage rates and record high house prices, you're not in a great affordability environment because incomes just aren't quite keeping pace. Here's the good news in that. We're already seeing income growth outpace nominal house price growth. Nominal house price growth nationally is in the low single digits, and actually in some areas like Austin, it's actually negative. So we have an opportunity for incomes to outpace price growth, which can allow some improvement in affordability. And we do think that that will happen by the end of this year. So slightly lower mortgage rates, still positive income growth, and sort of more normalized house price growth, if not negative in some markets, will allow affordability to catch up a little bit by the end of the year. And that's certainly welcome news for potential first-time homebuyers who are really struggling to get off the sidelines, right?
Yeah, it's interesting you said that. At the conference yesterday, one of the presenters who covers the rental market said that the first time home buyer age shifted from 37 to 39 years old.
Wow.
I don't know if you saw that
I did.
statistics,
I have,
which
yes.
yeah, so which really means that the renters market are increasing, and obviously folks that are playing into multifamily and rental market and Airbnbs of the world, long-term rentals, they have an age group of 21 or 22 years old to 39 years old before they commit to the first purchase. So that plays well for folks that are investing in rental, but at the same time, I don't see outside of, so the rates, they are steady, and the income is reversing course, but it's not there yet, right? So I almost feel that the home affordability will be a topic of the next 3 years, which I don't see a big resolution unless we start buying the manufactured homes from Amazon, from Elon Musk or alike, where we just assemble those boxes and connect the utilities. But it's there's a huge gap in the income from the one percenters to middle class now that are looking to buy a first home. The prices are still high. The gap on sell and buy side is still high. I don't know if you track those numbers, right? It's in the slides here, but the ask and bid prices are really far apart. And what makes things worse is when first time home buyers go and try to buy a property, the appraisers are estimating the price in the future to be lower, right? So there's no help from appraiser to say, well, right now the market price for Austin property is $100,000, but we are thinking that in the next year or two, the price will actually be 90. Therefore, it eats into the potential loan that they can give the first time home buyers. I mean, I know I said a lot, but do you agree with my assessment, or is there sort of a backup from your perspective that you find an echo in?
So I will say it depends, right? Real estate is local, and so we use Austin as an example. Austin happens to be one of those pandemic hot markets that's sort of readjusting and sort of normalizing. They were really, really hot over the pandemic, and now what goes up must come down, sort of mentality. Whereas if you go up to the Northeast, I have family in the Boston area, and they're like seeing bidding wars right and left, right? And it's really hot markets where you are seeing a ton of price appreciation. And what that comes down to really also is building. How much are we building relative to the existing stock? We know from our data that the Northeast and the Midwest hasn't really been building enough to keep up with demand, whereas the Sun Belt markets in particular have been building a lot more relative to stock. It's also easier to build in places like Texas. The regulatory hurdles are less than in the Boston area, and so we see a pretty strong relationship between where we're building more and where we're seeing downward pressure on prices, and where we haven't historically built and where we continue to see significant price growth. And I expect that dynamic to persist for some time. It's just comes back to econ 101, right? Supply and demand dynamics. And then all that has netted out to about single digit sort of price growth, which is probably a reprieve from the double digit price growth we were
Oh yeah,
seeing in 2020,
yeah. I mean,
2021.
there's a huge gap, and in the past, what did we see? 10, 15, 20% appreciation of real estate in Florida year over year, and it's right now looking at the Zillow estimates or First American estimates. You see that somebody that bought a house for 500,000, it's now 2 million. It just doesn't make sense, right?
It's a lot.
Yeah.
Yeah, and these are places where you're getting, you had a lot of people move, and I think I don't know if I have this. Yeah, a lot of people moving into these areas, right? Anything in dark green here is domestic net in migration. So we had a ton of people moving into Florida and Texas, Phoenix, moving out of traditionally more expensive markets like LA and New York. And so the building ramped up to keep up with that demand. Now what we're seeing is the level of net in migration we were seeing over the pandemic has sort of slowed, but it's still there. And to your point for Florida, these are also markets where we're seeing rising insurance premiums. So from an owner's perspective, that adds to the cost. From an even from an operator's perspective, that is impacting their bottom line as well, having to pay more for insurance premiums. And so we're getting this population agglomeration in high risk climate areas, which is an issue that we need to deal with. I mean, 5 to maybe 10 years ago, I wasn't talking about insurance premiums when I was talking about affordability. It was just principal and interest. And now, I mean, I have to talk about insurance premiums because it's not just a problem for potential buyers, it's a problem for existing owners, especially those on fixed incomes who are seeing both their property taxes and their insurance premiums rise.
And the rise is so significant that it affects not just the folks on the fixed income, but also folks that invested in real estates, the investors' rates. It eats in their profit. They don't raise the rents, but they have to, pay the double expense on real estate taxes.
Mhm.
I'm an investor in Florida, and all the properties have a double real estate tax. Why? Because in Florida, they look at the market value of the property today versus 3 years ago. in my example, it was 500,000. Let's say property taxes were $1,000 or $5,000. And if the property is worth 1.5, $2 million today, it's triple. So
Yeah.
it's really hard to calculate what one would pay on the rental market. And like to your point, the home insurance, a lot of insurance companies exited the bad areas of California with the wildfires, of Florida with the floods, and only a few left, and they dictate the price. And everybody has to pay that price because there's nobody else left. So it really becomes um, a market where we don't talk about it enough, right? It it plays into affordability crisis because if I'm a first time home buyer, not only I have to worry about P&I, payment and interest on the mortgage, now I have to worry about all this extra expense which I can't afford.
Right.
Is there a solution to that? Is there something that you think can be done and should be done?
I do. I think that there are mitigation that can be done on the property to make it more resilient in the face of some of these growing disasters. And I think that then the insurance premium can reflect that reduced risk. Right, changing your roof so that it's more resistant, like things like this that haven't had a ton of pickup. Though I have heard of pockets of the country where it's becoming more prominent, but I think that that can be one potential solution to lowering those premiums is simply to make your home more resistant to these disasters and then hopefully have that insurance premium reflect that reduced risk.
Yeah, and at the same time, it puts pressure on the builders, right? We just touched on the builders as well. Now they have to put more money to get the discounts, as you're referring to, or tax deductions for some of the things that will make home more efficient, or heat efficient, or energy efficient, and that certainly is something that we should see in the builders' stocks and numbers. I think they came out with a pretty poor um, builder sentiment. I was not
Yes.
following that. Yeah, maybe you can comment on that as well.
I certainly can. Yeah, the builder sentiment was negative across the board. Not only was the overall sentiment number quite low, but the underlying components that talk about single family, current market expectations and buyer traffic and future were both very low as well. And I think that that's just a combination of, you mentioned, costs. Costs are over 40% higher than pre-pandemic, like building materials specifically. Labor is hard to find. Skilled labor is hard to find. Post global financial crisis, we've had this shift away from trades. And so it's really hard to find skilled labor. And if you do find it, you have to pay more to attract and retain. And so they have these higher costs. Lots are more expensive, rates are high, financing costs are high. And now they have these tariffs, which the National Association of Home Builders, we're estimating that the cost of the tariffs would be about $11,000 added on to the price of a new home. And, not all of that can be absorbed by the builders. It's going to show up in the final sales price to that ultimate consumer. And so it is a challenging environment for builders, to your point.
Yeah, it's um, I have one more spin that I wanted to our discussion. I wonder, and that's not going to happen, but I wonder if Trump would allow a immigration to start flowing back to U.S. based on the wealth status or education status. That should really fill the gap for some of the demand that people would pay cash when they typically immigrate from other countries, or if they do a transfer of currency through the crypto, they have cash to spend, right? And certainly allowing builders to take in crypto as a payment of currency or payment for the home, as well as closing in crypto. I think a few folks nibbled at it, but I don't think it went anywhere. And at the same time, the lack of immigration that will bring money to United States to fill that gap between the wealthy um, wealthy people coming in and buying for cash. But that doesn't help on the affordability crisis, right? It actually makes it worse.
Yeah, I mean, immigration is crucial not just to building, to the construction industry, but also just generally to our labor force and contributing to our labor force participation rate. And also, ultimately, when we talk about housing, we talk about household formation, and that is also dependent to some extent on immigration levels and what those look like going forward. More people in the countries, more demand for housing. So, uh, all of it is wrapped in the outlook for immigration.
Yeah. One thing I wanted to add. This is actually very cool. You'll appreciate what some of my clients are doing. So most of my clients are Wall Street firms, hedge funds that are buying in bulk billions of dollar transactions, and I end up running diligence for them um, on the complex securities. Um, one of the funds called me 2 weeks ago, um, asking me to run a portfolio analysis for mortgage applications, 1003s, and extract using AI, extract the employer information and also grab the verification of employment forms and grab the employer information from there and feeding that through a filter of companies that are affected by the layoffs of Doge, as well as the tariff affected companies. Example, Amazon. If somebody works for Amazon, then they put a more risk on that particular portfolio with
Wow.
employments. Yeah. Or if it's a Washington D.C. individual with a .gov email, they're saying, well, there's a high chance that if the employment is more than 1 quarter, which is a Trump presidency, the high chance that person might be out of a job, right? So these type of tricks people are now starting to put in the macroeconomics in the US to evaluate where the risk pockets are and judge the by the employer's name if sort of they see a risk in their portfolio and how to handle that risk.
Wow. And also what an interesting use of AI, right?
Yeah, so a lot of things are going on, which is I'm glad you got the kick out of it because
Yeah.
it's a macroeconomic view that actually First American can deploy as well. Um, let's get back to the sort of a affordability crisis,
Sure.
and I think that ties back to the migration chart that you show here. Um, so I think what we're both saying, there's not an easy way to fix affordability.
Not an
Um,
easy way. Though I would argue that the most sustainable way is on the supply side. There's been a lot of talks over the years about helping affordability on the demand side, right? Like offering first time home buyer credits and things like that and down payment assistance. And that's great. But what ends up happening is that's capitalized back into home prices. If you're pushing the demand side of an equation and there's not enough supply to meet it, then it's just going to be reflected in home prices. So, the more sustainable long term solution to affordability is to build more homes and in places where people want to live. And that's challenging. And you mentioned manufactured housing a little while ago. I'm all for it. Build more housing in build good housing that in places where people want to live. And if that's through manufactured housing, I think it gets a bit of a bad rap. But then yeah, that's how we solve that problem.
yeah, and I agree with that. I think for the first home, I don't see any other option but to think about, tiny homes, manufacturing
Sure.
of tiny homes in the US. For whatever reason, whenever I watch YouTube or any social media, it pops up as an ad on my channel that, buy the manufactured home. I don't know why I would be the client, but it tells me that there's a market for it, right? So Elon Musk invested in it, right? Amazon is investing, um, certainly in the high-priced areas. I'll give you an example of Naples, Florida, right, where the average price of the home is real unaffordable, and at the same time, folks that are providing services in the restaurants or schools or what have you need to live somewhere. So there is a place for things like tiny homes or manufactured homes somewhere outside of those very expensive places. I mean, San Diego, for that matter, right? So very expensive to buy a property in San Diego. What do? I mean, you have to allocate, some areas, some land to build the homes that folks can afford. And it's to me, it's upsetting because it's completely different dynamic, right? We
Mhm.
have such a big gap in the income that I don't even know, the percentage, you probably do, percentage of population that can't afford, and that's not going to be pretty for some time.
Yeah, I do have the percentage.
Okay.
Uh, so, I mean, we like to you make a really excellent point that, on the incomes, because something that frustrates me about affordability measures that exist out there is that they just use average income, but in that you have owners' incomes, which are on average twice as high as the renter's income. And when we're talking about affordability, who are we really talking about? We're talking about the person that doesn't already own a home. We're talking about the renter that wants to become a homeowner. So we created an affordability measure that tracks renters' income in all markets, all major markets in the US. And we're able to look at the full distribution of sales in that market. And we can look at that distribution of renters' income and almost create this equality inequality measure where you say, well, in a totally affordable, sort of egalitarian market, that 50th percentile renter should be able to afford 50% of homes available for sale. In, the 100th percentile, like Bill Gates of renters should be able to afford 100% of homes for sale and then, so on. And what we found nationally is that the median renter can only afford about 28% of homes available for sale right now. And then when you go to places like LA, it's like less than 2%. And you can imagine that 2% stock probably needs a lot of work, right?
Oh, yeah.
And then you have markets that are a little bit more affordable like Louisville and Memphis and Detroit, where that median renter can afford a higher share of homes available for sale. But I really think that that's how we need to be looking at affordability for the people that have not yet purchased a home, that want to break into the market, and how their income plays into the current environment. And unfortunately, the picture is a little bit gloomy at the moment. But bright side here, we have been untethering ourselves from the downtown office, right? So in some cases, you do have an ability to move to a more affordable area.
Yeah, and in fact, COVID taught us one thing: any company can survive with people working from home or hybrid, right? So it's a choice of a company to bring everybody in office, but in essence, you can have folks working from Louisiana or Mississippi area, and they don't have to come into work if there are tools available to monitor what they're doing on a daily basis. So so I think there's something there, and getting back to your point, I do see a trend now. Uh, usual trend: people from California moving to Vegas, right, to Nevada. People in Florida now moving out to, as your chart shows, to other more affordable areas,
Mhm.
Georgia, South and North Carolinas, and
Yes,
I don't know what.
Carolina's big
Yeah,
in migration. Yes.
and you show it here, right? It's all
It's all green.
green.
It's all green.
Yeah, yeah. Yeah, and you see that folks that move to Miami area and Palm Beach and Boca and the expensive place of Florida, Naples, they're moving out, right? So there's a loss of population. I'm surprised that Texas is losing people, right? You're showing that half of Texas is also moving somewhere.
Parts, yeah,
Yeah,
parts is some domestic outmigration, yeah. Texas, the major metros in Texas have seen a lot of growth. Austin, obviously, if you've ever been to Austin, they've had a lot of net immigration.
yeah. I get a kick when I hear somebody on the YouTube or internet or news channel. The prices will fall 30%. Oh my God, everything will crash because I live in Austin. I see this nightmare where I see Sarasota, Florida is dropped in prices by 15%. It's a crash overall. You don't show it here.
No.
It's very balanced. It's depending on the local market. No panic. Prices are not dropping 50%.
No, and I have a lot of slides between where I'm about to take you, but I will show
Take me,
you.
yeah, go ahead.
So by the way, this is that renter affordability measure I measured here. So Memphis here, that 50th percentile renter can
Yeah.
afford about 45%. And then unfortunately, our California markets all the way on the other end of the spectrum here, where that median renter does not have that opportunity. And then the relationship I mentioned earlier, which is, in areas that we're building or permitting a lot more homes relative to stock, are areas that are also seeing continued growth in prices. insurance premiums. So this is, I think, what you're talking about here. So the top part of this chart is showing you how much home prices increased from pre-pandemic to peak, and then the bottom is how much has been lost since that peak. And the first thing that stands out is most markets here, a lot of markets here, actually don't even have a blue bar, which means they're continuing to reach new heights when it comes to house prices. And then the markets on the other side, like Austin, San Francisco, Tampa, Phoenix, these are markets that have lost some price, lost some ground in price growth. But I mean, they had 65% house price growth over the pandemic. So sure, we have a 10% decline, but if you bought over that period, you are sitting on a ton of equity. And so, even if you get a little bit more, and I suspect they might, unless you really bought, really at the peak of the market, you're not going to be in a foreclosure situation. This is one of the primary reasons why we have not been forecasting a foreclosure wave, is because to have a foreclosure situation, it's a result of a dual trigger. It's some kind of loss of income, right? An inability to pay, so, your spouse passes away, or, you lose your job. But then the other side is that you don't have sufficient equity, because if you lose your job and you have sufficient equity, you don't need to give your house back to the bank. So we're sort of in the situation where the labor market is cooling and turning, but not, people are still, unemployment rate's still low. Plus, we have the significant equity cushion. And so we're not forecasting a foreclosure wave. We do think there will be a rise in foreclosures. We're certainly seeing some distress in the FHA borrowers, especially those over the last couple of years. But debt to incomes are quite low. People refied into super low rates. So if you do happen to have a situation where, one spouse loses their job, chances are you're better positioned to afford that mortgage payment because you refied into a 3% rate, over the pandemic. So from that perspective, it's a better situation, and certainly, nothing like the global financial crisis.
So no foreclosures. That's what we're projecting. Poor
No
Darren
foreclosure wave.
Lundquist. No wave. Poor Darren Lundquist from auction.com, because he's expecting it in towards the end of the year, and that's probably auctions bread and butter as far as I know. But what's interesting is you are calling for no foreclosure wave, but market freeze on the sale side, because people are holding on, still holding on to their low interest rate mortgages.
Mhm.
Somehow they'll find a way to pay the bank, and they have enough equity to tap into to extend and pretend for next year. Is that the right term?
Extend and pretend I've been using in the commercial sense, so it's interesting to hear it on the residential side.
Oh boy, I got to touch on commercial real quick. So yes, so basically what you're saying here is, um, prices are stabilizing. There's not enough homes built in some areas, like you showed Philly and other areas where
Northeast,
it's
Midwest.
still profitable to build and rent out. Renters affordability crisis, credit card debts are rising. So there's potential of bankruptcies probably going up, right? Because some folks are not able to pay credit card debt, auto debts. Repo business of auto cars will probably be picking up as well, if I would be a betting man. And then certainly we need to find a way how to solve the affordability crisis. And let's touch back on commercial, because I'm really confused what's going on. 2 years in a row before elections, we had a commercial crisis. A lot of the commercial maturities were or commercial loans were maturing last year and this year.
Yeah.
And I am an investor in one of the funds. I know we lost two commercial multifamily properties to the foreclosure. Nobody's talking about it. And I don't see a lot of profit from multifamily for all the folks that were buying to buy, rehab, and raise the rents business, right? The I guess it's an RTL of multifamily. So I have no idea what's going on. I mean, why don't we talk about it? The problem didn't go away. The mods are not no longer there. You had one bite of the apple. You did it somehow. Are we kicking the can down the road, and why we're not talking about
Yeah. Oh my gosh, we need a whole other episode,
it?
Alex.
We should.
we're touching on commercial in the last couple of minutes here. So I think there's a lot going on in commercial, and there's it depends on the asset class that you're talking about. When I look at multifamily and industrial, I do think that the fundamentals are still supportive in those asset classes. Office has its own issues, right? Structural issues that came about during the pandemic. Retail is a really interesting one because obviously there's been a lot of talk about the shift to e-commerce, which has been a headwind. But really, where we're seeing that struggle is in malls, and not even Class A malls. Class A malls are probably still busy, but retail has also been underbuilt, and so there's a whole sort of story there on the retail side. But you mentioned maturities. So there's about a trillion. We've been talking about the maturity wall for a while now, right?
Yeah.
That was headline for a while. And there's about a $1 trillion coming due this year. And multifamily makes up the bulk of that, but that's because there's more multifamily properties than any other type of properties. And office has the highest delinquency rates. I think we're at double digit delinquency rates in office, like similar to the global financial crisis. And as loans come due, sellers will be forced to the market. But there's been a lot of this amend and extend and pretend, whatever you want to call it. Out of that $1 trillion that I just mentioned for this year, 385 billion was actually rolled over from the last year. So I do think that lenders are working with borrowers where the property has a future. But if the property doesn't have a future and the owner isn't putting, more skin in the game, I think that this is actually going to be a driver of activity in the years to come. And we've been a little bit cautiously optimistic on commercial. We do think we're at the beginning of a new commercial real estate cycle, and put the interest rate story aside. Maybe the Fed doesn't cut rates, maybe they do. I think there's a price story here. The gap, the price expectations between buyers and sellers. We saw a lot of price declines, and now across all asset classes, we're starting to see price growth. And I think that that's really an important part of the story. If you put interest rates aside, is that we're getting to some agreement on price, which should allow transaction volume to pick up.
More equity. Yeah. Yeah, absolutely. That's interesting. All right, so let's okay. So let's pause that commercial discussion. Maybe in a quarter,
That'd be great.
we'll jump on the phone and talk about commercial because I am really confused, and let's leave the audience very confused as well. Because personally, I still I don't think we're out of the woods yet on commercial, and we're just like you said, extend and pretend. Was that the term of John Toothwick from Raymond James? Is that his? No.
We might want
Okay.
to fact check that one.
All right. Yeah, we'd better do that. He uses that all the time. So I wanted to thank Odeta for coming on the podcast. Any final remarks, and where can people find you and follow you and subscribe for your channel? I think you have a channel podcast as well. So anything that my audience can come out and find you on a social media.
Yeah, absolutely. I think, the big takeaway of the entire conversation is there's a lot of headwinds, a lot of uncertainty. On the residential side, I still think we'll probably have a slightly better year than last year, just as people are getting more used to the lock-in effect, right? They sort of have come to terms with the fact that we're not getting 3% interest rates anymore. Life decisions are prompting some sales. And then, the new home side of the market, they're offering some buy downs to get people off the sidelines. So it's gonna be a challenging year and a slow sort of start to a new real estate cycle, but I do think that we'll start to see some movement. But a lot of uncertainty. That's the name of the game. You can find me on all the major social media. I'm on LinkedIn. I'm on X. I'm on Threads. I'm on Blue Sky. And then our blog is firsthand.com/economics. You can subscribe to that. We put out content on the residential and commercial side, and our podcasts, which are 10 to 15-minute episodes, are it's a biweekly podcast called the Reconomy Podcast. So thank you again so much for having me. It was a real pleasure.
Odeta, thanks so much.
Thank you.